Private credit journal entries look easy until the interviewer says the borrower paid no cash, but the fund still booked income. Show me the entries. This is where candidates get exposed because private credit is not just debit loan, credit bank. The traps are OID, cash interest, pay in kind interest, amendment fees, prepayment premiums, and fair value movement. Let's use one case. A fund commits to a $10 million term loan. The loan is funded at 98. That means 2% OID. The fund also earns a 1% upfront lender fee. So on funding, cash funded is only 9.7 million. A simplified entry is debit loan receivable 10 million, credit cash 9.7 million, credit unamortized OID 200,000, credit deferred fee income 100,000. Some funds present OID and fees net against the loan depending on policy. But the interview point is this: OID is not day one expense, it is part of yield. It is recognized over the loan life. That is why effective yield is higher than the stated coupon. Now move to interest. The loan carries a 12% annual cash coupon. Monthly interest is 10 million times 12% divided by 12, that is $100,000. Entry: debit interest receivable, credit interest income. Now notice the trap. Income can hit NAV before cash arrives. Accrued income and cash received are not the same thing. Also check day count convention. Actual over 360 and actual over 365 can give different accruals. Now cash is received. The borrower pays $100,000. Entry: debit bank, credit interest receivable. Do not record income again. Cash only clears the receivable. Now the real trap. The interest was due, but no cash arrived. Do not automatically say it becomes pay in kind interest. Unpaid cash interest is not automatically pay in kind interest. First, check the loan agreement. Is pay in kind allowed? If not, the amount may remain receivable only if collectible. If collectability is doubtful, review non-accrual, impairment, or income reversal depending on policy. Now assume pay in kind is allowed. No cash comes in. The interest is added to the loan balance. Entry: debit loan receivable or pay in kind receivable. Credit pay in kind interest income. Cash does not increase, but the loan balance increases and NAV may still increase. That is why pay in kind is powerful but risky. It creates accounting income without immediate cash collection. Now comes the amendment fee trap. Midlife, the borrower pays a 25 basis point amendment fee. Do not jump straight to income. First ask, is this a modification or effectively a new instrument? If it is a modification, the fee may be deferred and amortized into yield. If it is an extinguishment or new instrument, the old carrying value, remaining OID, and fees may need different treatment. So the interview point is assessment first, entry second. Modification or extinguishment drives the accounting. Now look at prepayment. The borrower prepays the loan at 102% of par. Cash received is 10.2 million, but $50,000 of unamortized OID is still on the books. Because the loan exits, the remaining OID is written off immediately. Simplified entry: debit cash 10.2 million, debit OID write-off 50,000, credit loan receivable 10 million, credit prepayment premium income 200,000. Labels can differ by fund policy, but the logic is clear. Par comes off the books, premium is recognized, remaining OID is cleaned up. Now add fair value. If credit quality deteriorates and the loan value falls from 10 million to 9.6 million, the fund records a $400,000 unrealized loss. Entry: debit unrealized loss. Credit loan investment or valuation adjustment. That reduces NAV. but it is not the same as a cash loss. So here is the interview framework. Funding creates the loan asset. OID and fees are just yield. Cash interest creates receivable and income. Cash receipt clears receivable. Pay in kind increases the loan balance without cash. Amendment fees require modification versus extinguishment assessment. Prepayment premiums require OID cleanup. Fair value movement changes NAV. If you explain the why, not just the debit and credit, you sound like someone who has actually worked on private credit funds. Now test yourself. The borrower paid no cash, but the fund booked income. Is it wrong? Maybe not. It depends whether it is accrued cash interest, permitted pay in kind interest, or an amount that should trigger credit review. Comment PIK if you want the pay in kind entry next. Subscribe to the Fund Desk for more fund accounting interview cases.